first read it today and rethought about it from the first half, I had to think about it for a second because sometimes it's hard to be a bull rider. Oh, I get it. The market, stock market being a bull rider. And Chris, I have to say, I mean, you did a pretty good job as far as what the expectations were heading into this year and then what actually transpired. So talk a little bit about what you meant in the first half outlook. And this is still on YouTube, guys, if you want to go check this out, our first half outlook sometime later. What did you mean when you said the bull is sometimes harder to ride?
Thanks, Troy. So we sit down. Charles and I have been doing this, for years. I guess I'm kind of the market historian on the team. So I study a lot of cycles. Try to come up with a catchy title for it. And just so happens, 2026, when we looked at all the data, whether it's second-year presidential terms or economic cycles, it looked like it would be a volatile, at least first half. So we came up with the title. In some years, being a bull rider is harder. So, we thought earnings were going to be good, the economy would be resilient. There were a lot of pro-tax policies coming from the president and the White House that would help earnings and help the consumer. Thought that was there. However, there were a lot of things kind of behind the scenes that were little warning signs that volatility in the first half would be higher than normal. Inflation was picking up even before the Iran conflict. We saw that. I'd kind of message it that it got worse because of the Iran conflict, but that was kind of the spike of it. But so, the market dropped, I think it was almost exactly 10% in the first quarter and ended the first quarter down almost exactly 10%. And then we started, I guess, to solve the Iran conflict back at the end of March. And the market immediately snapped into earnings mode. We're going to look at, companies that are growing fast and focusing on fundamentals, and pretty much V-bottomed and rallied, off the bottom almost 21% in a straight line over 2 months. So we weren't expecting that, out of the gate, but that's the kind of move we were thinking about for the first half. Looking at the second half of this year, I tried to come up with a catchy title, and I have to say the same thing. It looks the same. Some years being a bull rider is harder, and we're going to talk about the reasons that are both headwinds and tailwinds. But I would expect volatility to continue for the remainder of the year. Hopefully not as much as it was today, but I would prepare for volatility. The economy's okay, but there's just things out there that are kind of bubbling up.
Earnings matter, right? Earnings matter. So we have volatility is normal, and earnings matter. So Charles, when Chris put out the first half outlook and we talked about expected volatility, but at the same time, we saw a lot of positive currents supporting continued market growth. We talked about earnings from corporations. We talked about economic resilience, and we talked about the expectation that interest rates would come down likely sometime in the first half of the year. So out of those three, economic resilience, corporate earnings growth, and interest rates, which they have not come down, we missed that one. Where we are today compared to what we thought at the beginning of the year, which one of those three surprises you the most where we sit now?
Yeah, great question. Thanks, Troy. It probably is not just the resilience of corporate earnings or corporate profitability. It's the fact that it just continue to grow at a very fast pace. That's so critical to how we view the world and how we make fundamentally driven, earnings-driven investment decisions. Companies have done a fabulous job of really honing in and taking advantage of the three things that we always talk about that drive corporate profitability: sales, margins, and return on invested capital. And we've seen a handful of secular growth themes, particularly within the technology sector, but it's supported other areas, including utilities, energy, and some of the industrial sectors of the economy that have led to very resilient and improving rates of growth in sales. Corporate profitability has held up astoundingly well, right? And so a large portion, you hear about productivity gains. And what does that mean? If you think about it on a big macroeconomic standpoint, it's the amount of GDP you're able to get per unit of employment that you put into it. How much do you get out of the amount of labor or effort you put into it? A lot of the productivity gains have accrued directly to the corporations that are employing, streamline operations, better supply chain management coming out of COVID, use of technology to improve corporate profitability. And man, there's a lot of opportunities for these guys to reinvest in the best portions of their business. And they've just created this flywheel effect that's led to this very robust earnings backdrop that has really held everything together. And to take a little bit of a different view, although we've had all of these other issues take place, not the least of which was, a war, market's been very resilient. Why? Because it always falls back upon earnings growth.
And that's, again, getting back to the theme. So earnings resilience. Chris, I know you kind of feel the same way. Tell us a little bit about that, how you feel.
Yeah, no, I'm right with Charles. I think unless something strange happens in the next week, the second quarter will be the 6th consecutive quarter of double-digit earnings gains in the S&P 500. And I think it's either the second or third over 20%, which outside of coming out of recessions never happens. So the earnings picture has been extraordinarily strong the first half of 2026. We continue to expect it to be strong for the year, but particularly in the upcoming couple of quarters.
Good news is the same primary driver of the stock market performance over the past, let's say, 6 months, just isolate that time frame, is still in existence today and is still likely to drive the stock market higher, potentially drive the stock market higher over the coming months.
Yes, exactly. Well said.
Okay, so Chris, now what about a headwind? What's something that could counter Charles's point about earnings growth?
It's on the same thing. It would be peak earnings growth. So far, looks like it'll probably be the third quarter of this year.
Okay, so let's define peak earnings growth.
And that's rate of change. So
okay, let's define rate of change.
So yeah, in the stock market, the stock market rewards, bad goes to poor, goes to good, goes to better, goes to great, right? It doesn't reward great goes to good.
Yep.
And it has a really hard time because then it thinks good goes to mediocre goes to, it extrapolates linearly. And right now we're growing earnings, not exponentially, but at an accelerating rate. I think fourth quarter was in the high teens. First quarter was 20.5% or something like that. This quarter is supposed to be 21.5%. And then you get to the third quarter and it's in the 23.5%, 24% year-over-year rate of change. But then you get on the other side of that and it starts to slow down just because the comps get harder. It's just hard to grow earnings in an economy at 20% plus.
So to Charles's point, corporate profits are still growing.
Yes.
But to your point, they're not growing at the same rate that they were previously.
That would be in the projection for the third quarter would be the peak growth rate. Therefore, the fourth quarter would be a slowdown in the high teens.
Yep. Yeah. So imagine, let's say you own a private investment and it's a business that you run. Let's say it's a small company that sells widgets and you have 20% growth this quarter, 22% growth. Let's take it 4 quarters ago. You have 20% growth. Then you have 22% growth. Then you have 26% growth. And then this past quarter, you had 24% growth. So that rate of change, you went from 26 to 24. Even though you still grew at 24%, the stock market is saying, hey, guess what's happening here? They went from 20 to 22 to 26, now 24, came back a little bit. The stock market cares about that rate of growth, and that's what could potentially lead to some volatility in the second half of this year. The rate of growth slowing in corporate earnings as a headwind from you, Chris. What's another headwind that we should be aware of that could cause the market to be quite choppy moving forward?
Headwind would be not sure with the new Fed chair, what's he going to do? He clearly is going to change the messaging profile relative to Jerome Powell and relative to the last probably 20 or 30 years. He's a disciple, I think, of Greenspan, who just passed away. And, less information, less talking economists on TV, I think is what Warsh is going to go for. The good news is, at least for us, hopefully, is he actually was involved in the financial markets with tradable financial markets, not as a lawyer doing private equity for a few years. So I think the data that he's going to look at will be more real time and less these, 6 weeks to 8 week old government data that's revised, 10 times and people ooh and ah over it. And it turns out to be meaningfully wrong. So,
okay, so new Fed chair.
There's new Fed chair, and some
uncertainty there
well,
regarding what they may do.
Too. Yeah, and they're usually tested. In the history of new Fed chairs, I think the last 7 of them have been tested by the financial markets somehow, whether it's an inflation scare, a growth scare, some shock overseas. I think, they've all been tested. Markets have declined anywhere from 7 to, double-digit rates, over 20%. Whether it's a coincidence or not, expect probably later in the year Warsh to be tested some kind of way. We can guess it why.
If for no other reason, merely the fact that there will be less communications in between meetings means that when the meetings happen and interest rate policy is made, there's going to be more volatility. There's going to be more variability to the potential outcomes of what happens, and that in itself will create volatility.
I think people have gotten so excited about it, they forget that SpaceX is really 3 companies, and there 2 of them when they were private were essentially monopolies. Starlink was essentially a monopoly, and SpaceX, was a monopoly that even Elon said he didn't think was going to work, right? And SpaceX has been the rocket company's been in business 22 years or
has
almost
been
20
it's been a while.
It's an amazing amount of time. So it's just been in the last couple of years when he bought Twitter, and then he bought Grok or XAI. That's where all the money's going. And those are not the leading companies in the field, right? He's trying to play catch up and spending a lot of money to do it. And as a public shareholder at a $2 trillion valuation, when the valuation I think was $500 billion 6 months ago, it just doesn't make sense.
Does the rate of earnings growth decelerate, which could cause some type of sell-off, and volatility because of the various factors that are ongoing and being in, let's call it a late stage of a bull market, is normal? Is that volatility something that you can withstand? Because we've got a lot of questions. We got them pre-submitted. We have them in the comments. Should I sell now and get out and wait to come back? And this is where the plan matters, right? If you sell now, what you're ultimately saying is you're guessing right now, and you're going to be able to guess right a second time on when to get back in. And we all know that's unlikely to happen. So the probability of getting both of those right is extremely small, and over long periods of time, you're most likely costing yourself money. And Charles, I want to let you respond to this one first, but I want to first say this because this is important. Do you know what the difference between gambling and investing is? So think about it for a second. What's the difference between gambling and investing? The longer you invest, the more likely you are to win. The longer you gamble, the more likely you are to lose. So volatility is to be expected, but have a proper allocation to equities as part of an overall plan. Know where your income's coming from, make it durable, make it predictable, make your income growing, and of course, make it liquid. Replicate that paycheck in the retirement phase, the thing that made decisions that were financial in nature much easier when you were working in the accumulation years. Replicate that in retirement and allow the stock market noise to not bother your quality of life. That's the secret, and that's what we do here at Oak Harvest Financial Group. So, Charles, when we talk about some of the questions here, we're going to just put a bunch of them into one. Some of the pre-submitted questions, some of the comments here, what is so difficult about getting out when people feel that the market is volatile or they feel it may go down? Why, in your experience over many years of doing what you do, is that unwise because the unpredictability of markets?
Yeah, well, it tends to be emotionally driven, number one, and it's not based upon reliable statistical objective indicators, which is what we tend to look at. Chris and I can take a step back and take a very objective look at what's going on. But as an individual who sees maybe the value of their account fluctuating a lot, that becomes a very difficult emotional decision for them.
Or watches the same news program every night.
Yeah.
And they see the headlines every single night. Or even if it's different news programs, those are things that are meant to tug on the emotional strings. And those things, the same things that make you uncertain about your portfolio, are the same things that keep you tuning in to that same show every single evening or every single morning.
Sure. I spent a lot of time thinking about the elements of behavioral finance, and we sit in just an incredibly interesting intersection of how people think and how people behave. And again, it boils down to the value and the importance of having a human being as a financial advisor as opposed to, some crazy, AI generator or whoever trying to provide investment advice. You need a person that's got experience that can help guide you into not making irrational, emotional decisions. Chris and I are just in the back. Chris and I work in the kitchen, making the best possible, meatloaf, mashed potatoes, green beans, whatever it may be, that to achieve a particular function, figuring out and talking with the client how much of each of those, and they're all different, all the clients are different, how much of those should be used to create the meal for them. Yeah. And so we can take a step back and view it very objectively. And I think, and then having a person to kind of help guide you through that process and understand what their plan looks like is just an incredibly valuable aspect.
Chris?
I would just ask for all you who are contemplating that, do you have a successful career in investing doing it, right? Every time you've thought about pulling the ripcord and going to cash, did you do it? Did it work out? Did you get back in? What did the market do the next year? What did it do the next 3 years? Because I've met very few people who ever could get both decisions right. And most of the people I ever talk to are calling when volatility is super high to make changes, and they want to move out, which from a pure data perspective, and right now this is not high volatility. This is actually normal volatility. Yeah. Right. VIX at 2021 is normal where it is for the last 30 years.
Chris, give you a couple of final thoughts, and maybe if one of you guys want to talk a little bit more about the potential for rates to continue to increase. We're talking about, I don't want to get into real rates, but just the 10-year treasury, but then also an increasing dollar, because I think these could be headwinds into the second half of the year. So any final thoughts? Then we're going to do the giveaway on anything that you have to say, and then talk just a little bit about the strengthening dollar and what happens if interest rates go higher.
Yeah, no, great points. Those are two headwinds, right? A stronger dollar from a consumer standpoint is great, but from a financial perspective, the markets don't generally like it because it's a headwind to earnings, because so many of our companies sell products overseas. The dollar is going up right now, largely because we're one of the best economies in the world. Ourselves, Taiwan, Korea are growing faster than everyone else, so money comes here. But that's a headwind to precious metals. It's a headwind to overall industrial commodities because they like lower dollars. And as far as interest rates, same thing. If interest rates, because either our economy is too hot and people think they're going to raise rates, which is kind of what people are talking about now, or if it's back in like the first quarter and inflation was running up, Either one, if overall nominal rates inch closer to 5% on the 10-year, that's bad for overall stocks because you're discounting your valuation. Now, instead of that 21.5, 1 over 0.05 is now 20. So you're just getting multiple compression, even though your earnings are growing.
If we had 5% the 10-year, I wouldn't be shocked if we saw an 8-10% correction.
Or more.
But you have some numbers there, Chris. So I want to put this into perspective. So an 8% correction in the market, a 10% correction, a 20% correction. These things are fairly normal. So Chris has some numbers. We just want to go through these numbers, give Charles a final word, and then we're going to announce the final giveaway winner.
Yeah, and these are I'm giving creative planning. These are their numbers. So, and I have looked into them. They're great numbers. So, minus 10% declines in the S&P 500 once every 1.5 years. Okay, minus 20% once every 4 years. Minus 30%, which is essentially a recession, once every 10 years. And the dreaded, your money gets cut in half, is once every generation, once every 50 years. Once every 48 years, your money gets cut in half. And still, the market's at new all-time highs and is compounded over very long periods of time at double digits because earnings and the ingenuity of American companies to grow revenue and grow earnings over time.